I want you to consider this candlestick right here. Now, normally, this would be your first presented fair value gap. But there's a criteria that I'm going to show you when and how I use the 931 as the very first presented fair value gap. Now, there's nothing inherently wrong with using this one. You know, if you extend that throughout the day, eventually you'll get something over here in the afternoon, but you're going to discover that it gets real wild in here and it doesn't respect it as much as the level of that 930 1-minute candlestick. All right, so take a look in the lower right-hand corner. You can see that the chart now is toggled to regular trading hours, RTH. Okay, so we're going to see the gap, the difference between previous day's settlement price at 4:14 p.m. Eastern Time to where we open at 9:30 Eastern Time, the very next trading day. So it's not showing you all the fluctuations in price overnight in Asia, in London, and then before the new AM session at 9:30 Eastern Time. So you have to be aware of that price action still, but you can't ignore regular trading hour structure, which is what we're showing here, okay? So if you take a very close look at where we opened up from where we settled previous Thursday at 4:14 p.m. Eastern Time, we have a very large premium gap. That opening price here does two things. Number one, it triggers initial desire to want to be a buyer because a lot of retail traders just see the price being flashed on the screen and say, well, yeah, it's a strong opening. But what do we do after we open? That's what a professional perspective is, not where are we at in relationship from the previous day's close to today's open. That's retail. That perspective, that measurement of bullishness or bearishness is identified through that lens. But a professional sees it from where do we open at and how do we close based on that open. And you want to think about that for your sessions, not necessarily just limiting it to the daily range in its entirety. You want to be thinking about from the beginning at 9:30 to say 11 o'clock in the morning Eastern Time. So that's your AM session. Same thing for the afternoon. Where do we start trading at 1:30 p.m. Eastern Time for that opening range for the PM session? What's that opening price? The very first tick at 1:30. Then where we close at 4 o'clock. Yeah, that could be your entire afternoon range. And where we open versus where we close, that's the professional measurement of the lay of the land, how the market is delivered. So simply stated, we have a very high premium opening here. But if you're looking at regular trading hours, you're going to see that they opened it up above regular trading hours relative equal highs. So in here, we have Thursday's regular trading hours buy side liquidity. And now looking at this right there, this is your first presented fair value gap. Because it's done a raid on previous regular trading hours relative equal highs. And now with that opening here, we measure the opening range gap to find the consequent encroachment of that. As soon as we get the opening price right there, boom, you know that you're looking for 70% likelihood it's going to pull back into that opening range gap, 50% of it. When we see this, it's almost as if you have x-ray vision and you can read what price is reaching for and how it's engaging liquidity from both the regular trading hours market structure and also incorporating the same ideas with the electronic trading hours market structure, which we'll look at in a moment. But this right here, that consequent encroachment is that level right there. So it comes up later on, hits it. And if you look real close, there's going to be minor buy side liquidity rating here. So this white box is the opening range gap for the AM session. So that's 9:30 to 10 o'clock, that measurement. And we're looking for where we settled previously, which is here, and where we open. And that's what we're showing a depiction of that, okay? So we're blending two elements there, time and price. And we're also blending in the elements of regular trading hours, time, and market structure, and electronic trading hours and market structure. So what do I mean by that? Well, before we do that, I want you to notice that we have all this run up in here without having the need to take out that low. I want you to take a look in this little area right in here. Inside this area in here, if you don't take this low out and you're expecting the market to break down, what might you consider in this little area in here? It dropped down to the 1 minute chart. Now I had this compressed and I'm showing it through electronic trading hours now. So I've toggled my ETH, RTH back to electronic trading hours. I have the range shown here that makes the opening range gap. That's that white shaded box here. If we're looking at how the market trades from regular trading hours and electronic trading hours, you have to look at the stops that are there. You have to look at how the market delivers to inefficiencies, from inefficiencies to liquidity, from liquidity to inefficiencies. And stripped down, let's just say you were looking at just the electronic trading hours only, and you didn't even refer to regular trading hours. I teach you that going back from pre-market session, 7 o'clock in the morning Eastern time to 9:30 opening bell, that 90-minute window of time, that could be your entire trading canvas where you do all your work there and you don't care what it does after the opening bell. There's plenty of opportunities to do that. Or you want to use session trading to give yourself a little bit of a buffer and then trade heavier handed after you get the opening range and the true understanding of where the market's going to go after 9:30 opening. That's a little bit more advanced. That's what I usually do when I'm running up the accounts. I'll do things like that. I'll build in a buffer right before the major session I'm looking to trade, and that might be the afternoon. It might be I'm not trading in the morning because FOMC rate announcements coming out later in the afternoon. So I will do very, very little light-handed trading pre-session because I know usually the morning session is going to be quiet, lethargic, choppy. And then after the initial distribution of price higher or lower at the 2:30 conference when they're now going to listen to the Fed chairman speak, that's usually the real move. Take your attention back to some of the things I've taught using the obvious pools of liquidity that they cannot hide it from you, yet time first. So if we're looking at the 9:30 opening range, Eastern time for equities open, going back in time, what's the first thing you're going to run into? London sessions liquidity. Well, here you go. Here's London's low. What happens prior to that? Asia's sessions low. So those are two levels that we would be looking for when we have the market opening up, trading above this short-term high here, and then bumping it right there at the open. So just think about that for a second, okay? We have a blending of regular trading hours and electronic trading hours to see kind of like an envelope, a barrier at which we want to see price reaching for obvious pools of liquidity, is pointing to where was the high at, where was the low at in the Asian session, in the London session. And now we're building them for the morning session that can be used for the afternoon or lunch macro. So I want you to take a look at this. Buy side liquidity here, taken. Buy side liquidity here, taken. Buy side liquidity here, taken. And we're seeing this occur in electronic trading hours that leads to that big pump up that keeps us above the relative equal highs in the regular trading hours. Remember, we're looking at electronic trading hours here, okay? So the open, high, low, and close, and what time is the high and that low formed? Asia session, London session, pre-market session, 7 o'clock to 9:30 open. And then you have the 9:30 to 11 o'clock, where is your liquidity in net, because that's your AM session. And then the lunch macro will pull against that. Even if it's going to stay consolidation, or if it's going to reverse or continue, it's going to go back into the range for that liquidity that was formed at 10 o'clock, going into whatever it has done during the lunch hours. It does this every day, folks. Every day it does that. And then you have the PM session, which will use the lunch macro liquidity and or the AM session liquidity. And that cycle repeats over and over and over again. They cannot hide it from you. They cannot cause any kind of distortion in your data. Okay, everybody is going to have the same price high and low across all the brokers, because you're trading in a real market. You're not trading a CFD. You're not trading in Forex where every broker gets to mess around with the highs and the lows. That's what makes these markets better. But I want you to take a look at this area right in here. We're zoomed in now, and I want you to see all these highs here are just falling short of this area right in here, this SIBI, sell side balance, buy side inefficiency. Minor buy side liquidity here. The market stays in this consolidation. So at 9:30, we open, we hang around, bang around, bang around, bang around, and finally we retrace back up, because if it's going to go down, they're going to price in a premium and they're going to take out some measure of buy side. And that's this area right here. Trades right up into that level and then breaks, comes back up, breaks one more time. And in here, I'm looking for a short because we're in the lower portions now of this SIBI. All right, so this is your first presented fair value gap, and consequent encroachment of that gap is here. So you can see we traded up into it, bumping the buy side. Consequent encroachment of first presented fair value gap at 9:30, breaks lower, comes back up, hits it right one more time there, and we're staying outside of what? The upper half. That's order flow theory with my PD arrays. It's always like that. Market drops down in here. There's a fair value gap there. And then there's volume imbalance right here, separation between the bodies. So the market trades up into that and then breaks down, trading down into Friday's London sell side liquidity pool. All right, in the minute chart here, you can see I've identified the Friday London session liquidity, Friday Asian session liquidity, and then Thursday's regular trading hours. And earlier in the video, I told you to look inside that low, and you'll see that there's a little fair value gap right there. It's a buy side amount, sell side inefficiency, and we traded right down into that. You see that? So what is this level here? If you measure the opening range, high to low, and you run a negative 1.5 standard deviation on your fib, you'll get that projection that takes us below both London and Asia sessions liquidity right here. So that's the level. And it trades down to that inefficiency, but not needing to take out Thursday's low. All right, so strip down in a normal fashion. This is what my charts usually look like, and it looks like this when I'm doing the execution. When I'm showing it to you, here's the bump on the buy stops. Here's the opening range gap. First presented fair value gap. Inversion fair value gap. See this low here? That's the start of a new day. This is a first presented fair value gap at the start of the new day. Project that forward. You can see how it's being used here. And then they finally bump through it, leaves it, never comes back. That's a good thing. And then you have this sell side imbalance, buy side inefficiency here. Project that forward. And then here's a minor sell side liquidity that attacks. And then you have volume imbalances in here. And then you have Tuesday's PM session first presented fair value gap. It draws down into that too. Look at the bodies respecting that. All right, so we're going to moving in to a little bit more of the morning session here. We project that forward at fair value gap. Now we change its character from that of a sell side imbalance, buy side inefficiency, which is going to be used to sell off further to get down to our target. But now when the market has done our target, it's going to consolidate and trade above it. And now it changes its character. Its initial bearish character now becomes bullish. Look at respecting the consequent encroachment here, rallies back up into the actual first presented fair value gap at 9:30, falls short of going into consequent encroachment, comes right back down in, fair value gap, sell side, hits it, rallies, comes back up in, volume of balance, rally, and then we get back up inside of the first presented fair value gap. Trades up, comes down to lower quadrant, consequent encroachment, upper quadrant, and you're seeing the beginnings of the afternoon session in here. But this is the morning AM session, opening range gap, first presented fair value gap. Right here's the afternoon, and you can see that it's the first presented fair value gap for the PM session between 1:30 and 2 o'clock Eastern time. The market trades down to the low of the actual AM first presented fair value gap, rallies back above, consequent encroachment, and then look how it accumulates inside of the first presented fair value gap between 1:30 and 2 o'clock. It helps you identify the actual fair value gaps that's going to help you know which one to trust. A lot of you don't realize what I've done. I've pulled back the veil And I'm teaching you how to never fall victim to picking the wrong fair value gap. You'll never find that in any fucking book. The first presented fair value gap gets used here in a reversal of what its original character was. Over here, it was bullish because of the buy side balance, sell side efficiency. The market can use that if it trades back down and if it's bullish. But what happens if you're seeing the market trying to trade higher? It's used here to send price up. And then what happens when it trades below it? It changes its character. Now it's using consequent encroachment on that level to send it down into sell side liquidity over here. And zoomed in here, you can notice that we had sell side, buy side, this run here during the 315 to 345 macro rallies, last hour of trading. Look at the Thursday 60-minute premium wick. Okay, the highest 60-minute candle on Thursday's trading, there's a wick on it. Measure it so it shows just the 50% of the wick. That's what this level is here. That's the consequent encroachment of Thursday's 60-minute premium wick. It hits that, sells off, consolidates, and breaks. We have a shift in market structure here. Here's model 2022, fair value gap, breaks lower, trades to PM session first, present the fair value gap. That's always low-hanging fruit. And then it trades to the low of it, attacking the sell side here, and then just extrapolates to the downside.